Every investor has a preferred strategy for various reasons. With so many alternatives available, it might be difficult to choose the ones that best suit your lifestyle and goals. The stock market provides multiple opportunities to earn money, just as real estate investing, like other investing strategies, provides numerous routes. Value investing has been shown to produce significant returns and has even produced the world's fourth richest individual. Despite the fact that this technique frequently outperforms others, a value investor can make fantastic returns while others are losing money, and vice versa. What is value investing exactly, and how does it vary from growth investment or other strategies? Do you agree with the value investing mindset? Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Value investing is a method that involves buying companies that appear to be trading for less than their intrinsic or book value, signaling that the market has undervalued the firm and that the stock is consequently on sale. Similarly to how grocery stores run sales on various things, the stock market frequently prices items on sale. This is typical when the market overreacts to unfavorable news, causing the stock price to fall far lower than the company's financials reflect. Sometimes a stock is unfairly punished. When this occurs, value investors have the opportunity to purchase what appears to be a stock on sale. ExxonMobil, Johnson & Johnson, General Electric, and AT&T are examples of firms that have been underestimated by the market for a variety of reasons. Value investors base their financial research on criteria such as the price-to-earnings ratio, the price-to-book ratio, cash flow, risk assessment, debt-to-equity ratio, sales and revenue figures, and more. These investors typically go against the grain, purchasing equities that the majority of the market isn't interested in, have been sold off, or were never purchased. When a value stock is purchased, the investor believes that the market will eventually price the stock correctly, resulting in big profits because the stock was purchased at a discount. They also provide a margin of safety. Knowing the worth of something can help you save a lot of money if you buy it on sale rather than paying full price. Even if a company's valuation remains consistent, stock prices are continuously shifting. Simply watching the stock market on any given day will reveal price fluctuations, even in the absence of specific company news. Similarly, food store pricing is always shifting. Long-term value investing is a strategy. After you've picked your choices, you'll need to put in very little work. This reduces volatility and risk because frequent buying and selling aren't required. The transaction was done at a discount rather than a premium. Many value stocks also have high dividend yields. Despite the company's stable financials, dividend payments remain stable despite the stock price decline. Shareholders can expect monthly income that can be reinvested or utilized for retirement needs, adding to the stability of this strategy. Compare the strategy to growth investing, in which stocks are purchased at a reasonable price based on their expected future growth. Growth equities typically give little to no income, emphasizing the decreased risk of value investment. To put it another way, growth investors invest in anticipation of bigger earnings than other stocks. It is critical to maintain emotional stability when engaging in this form of investing. Following the crowd can be difficult at times. The dot-com bubble is a typical illustration of herd mentality, as investors witnessed great profits only to lose the majority of their money when the bubble burst. Investing decisions should be based on evidence and research rather than emotions or hopes for higher future returns. Rather than riding a market bubble to the top, this strategy secures long-term benefits. Value investing necessitates a thorough understanding of how to examine and value a firm, which is not everyone's strong suit. Learning to appraise a business takes time and effort, and seeing the fruits of your labor requires patience. It may take several years to see the value of your investments rise. It's not always an exciting procedure. On most days, value investors may see just minor changes in the value of their stock holdings. Warren Buffett, who is rated fourth on Forbes' list of billionaires, is well known for his career-long dedication to value investment concepts. Although he is a businessman and philanthropist at Berkshire Hathaway, he is best renowned for being one of the world's most successful investors. He consistently buys undervalued companies, much like a shopper looking for a good deal. Buffett avoids overpriced industries. Bank of America, Coca-Cola, and Kraft Heinz are among his main interests. When investing in a firm, Buffett's major concern is not whether the market will eventually recognize its worth, but rather how well the company can create profits as a business. Rather than depending on excessive optimism or investing on hope, he has consistently generated solid, healthy returns throughout his career, beating alternative growth techniques. Given that he has been investing successfully from the age of 11, he may know a thing or two about it. Individual stocks can be purchased if completing basic investigation on your possible holdings interests you, potentially giving spectacular returns comparable to Buffett's success. Buffett, on the other hand, claims to spend 5 or 6 hours every day reading financial reports and newspapers. While he appreciates it, others may find it quite boring. Investing in an ETF or index fund that only owns value equities may be a safe and simple option for many. Vanguard, for example, offers a value ETF, VTV, that exposes investors to over 350 different discounted firms, including JP Morgan Chase, Verizon, AT&T, and others. The most important areas are healthcare and finance, which appear to be undervalued in comparison to sectors such as technology. This product offers a 3% dividend return while charging only a 0.1% expense ratio. Several more ETFs and index funds with comparable holdings are available from a variety of companies. As a result, you don't have to be a financial genius to practice value investing. Buying and holding with little study can result in passive returns. Finally, value investing is a tried and true method with several benefits, even if it isn't the most glamorous. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?